Test. some, I think, yes. Ja, aber wir brauchen dann zwei nachher. Good morning. If I could invite you to come back in. Oh, you got some water, good. Come up on stage. So we're going to start in a couple of minutes. I'm looking forward to this.
Me too. Yeah.
Had a good evening last night?
I had a great evening. I will admit, I'm sort of sleep discombobulated, so I packed it in a little bit early.
Yeah.
I was talking to some of these people. I think there was a lot of midnight.
Oh, really? Yeah. I left also about some 9:30. I think I was pretty exhausted from. Yeah.
Very
but
fun,
I feel.
Very fun day.
Yeah. Yeah. I hope you had some interesting conversations.
Yeah, lots of interesting people. Yeah. Yes. I'm still looking for Ho Nam's, right? Caught up with. But I've got something. I may just get his email from you.
Yeah, he's around them. Yeah, I did actually see him yesterday and told him that you were looking for him, so he knows. Are you around this evening, or do you leave today?
No, I actually have to leave. I put my stuff
Of course,
here.
yeah, I asked
I'll
you
be
that
here
already.
for a little bit of the next session, but then I have to go.
Yep.
I'm actually going to London, so I have to.
Yeah, no problem at all. Yeah. Okay, if you'd like to grab seats, if we could get people in from the breakfast. Is there still a lot of people out there? Die kommen, ja, super. Very good. Yeah. Okay, well, I think there's enough. We can get started. Yeah. Okay. I also wear a T-shirt with a plug for Titless, so that's
I love it. Yeah, I was I had a jacket on earlier. I was like, it's just too formal and too hot.
Yeah, it's quite with the highlights. It's a little bit hot. Yeah. Okay, well, good morning, everyone. Thank you, everyone, for showing up on our second session. Today's Sunday. I was looking out the window just this morning, and we had the fresh snow yesterday, and happily we have the sunshine today. So I hope many of you can take the time to go up the mountain later on today. But before that, we've got 3 sessions. The first one will be with Will Thorndike on my left. Will, I'll introduce you shortly. Then we have the second session, which is titled Women Investing, which will be hosted by my daughter Amelie. And then the third one, we're mixing things up a little bit. We decided to try a topical one this year, and it's going to be called, somewhat provocatively, Is China Investable? And we have 4 panelists joining us for that session, all of which either from China or have a China connection. Great. So Will, thank you so much for taking the time to join the group here. Oh, and I just noticed you don't have a microphone, so let's see if we can remedy that. Are these live? Or? Test. How do I turn it on? Test. There we go. So Will, you are a hero to many of the people here, thanks to the book you co-authored called The Outsiders, and we will for sure talk about that in a few moments. But we would like to get to know Will the person first. So why don't we start? Why didn't you tell us, where do you come from? Tell us a little bit about your childhood and perhaps some of the formative experiences that led to you becoming an investor.
Great. So Rob, it's just great to be here. It's been 6 years since I was last here. And it's remarkable to see the growth in the audience here and the energy level. And so, anyways, great to be here.
Thank you.
So I'm from Boston, Massachusetts. I grew up there. I went to school there through college. I basically spent most of my working life there. So fairly parochial in that sense. I I'm the oldest of two brothers in a family of four. Grew up, as I say, in the Boston area. And my wife, who I met in college, also is from the Boston area. And we have two children. My son, Nick, who is our youngest, he's 26. He is an investor on the investing path in the allocator area is what he's interested in. And then my daughter, Charlotte, our oldest, is 29. And she is doing a master's program in social work at Columbia University and living in New York City. So I come from that area. Someone asked me yesterday why I don't have a Boston accent. And I think that's because my dad is from a family that's been in Boston for a while, but my mom is from New York, and I think their accents sort of canceled each other out, so I ended up with something in the middle. And let's see, so
how did you get into investing? What was the kind of initial trigger?
My career arc would be a bit unusual by contemporary standards in that I started after college. I got hired by a company that was owned by a high school friend of mine, a publishing business, and he offered me a job before my senior year started, so before I had even begun thinking about what I might do professionally. And this was the 1980s when the whole world of recruiting was very different than it is now. You did not need to get your career internship as a freshman in order to be headed down an investment path. So I worked for this business, which was a publishing business, for 4 years right out of college. And I had, by virtue of that connection with my friend and that family, I was given sort of undue responsibility very early on. So I had an excellent experience working there. But I knew from very early on that that was not what I wanted to do. And I had had this experience where in the first summer after college, I had gone to Maine on vacation. And I had brought books for that vacation, and it had been a rainy, foggy weekend, which can happen in Maine, even in the summer. And so I had blown through my book list, and I looked around the house I was staying in, and I pulled down a book called The Money Masters by John Train. I don't know how many people here have read that book, but that is an excellent investing book it's 1980 was when it was published, but it's still highly relevant. I read that book, the first chapter of which is on Buffett, very early in Buffett's career, and I immediately knew that's what I wanted to do. Light bulb moment went off for me. So the balance of the time I was working in the operating company, I was reading voraciously and doing what little investing I could afford to do. I sent away for all of the Berkshire letters, which you used to have to do by mail. You'd send out a note, and it would come back these thick packets of material. And anyway, so I went to business school at the Stanford Business School after that, and was fortunate enough to have a professor there named Jack McDonald, who is sort of a legendary professor. He was sort of I went to business school in the very early 90s, and he was a pocket of fundamental investing in a world of efficient markets theory. And he taught 2 classes in his spring class. If you got a good grade in the fall class, this was in the second year, then you were invited to the spring seminar, in which the format was you just showed up at the class, and a different amazing investor would come and talk to you for 2 hours. No prep. It was a perfect class for the spring of your second year at business school. And I just had a wonderful time in that class, and I was exposed in that class to a variety of investors. Buffett came every single year but my year because he was running Salomon Brothers. He'd been called into Salomon Brothers, so I missed Buffett. But I got to meet an investor named Tim Bliss, who works with an investment firm called the Investment Group of Santa Barbara, and had a chance to do some work with him, and was influenced early on by some of those ideas. Anyway, so I worked with T. Rowe Price in the summer between years in business school. That was a fantastic experience. They used to hire 1 student every summer, and then they would give them an industry and all of the resources of the firm, and then basically leave them alone, at the end of which you'd have to come back and give a report on that. And I was given the temporary help industry, which had never been covered there before. So that was a wonderful experience. So I knew I wanted to be an investor. I'd had this experience with Tim Bliss in my second year, and I was evaluating my options, including going back to T. Rowe and some other investing opportunities. And a private investor in the Boston area
T-Row is still happy to take you after the report.
We'll see. Yeah, they seem to be. They seem to be, actually. So, yes, they must not have been paying attention or something. But I was connected with an individual investor in the Boston area who approached me about going to work for him and a friend of his to invest personal capital in a very unstructured format where I was paid $60,000 in income, but was given a carried interest in their capital. And so they hired me, and I went to work in a closet in their office in the Back Bay of Boston. And over the next 4 years, we made 8 investments, all of them in private companies. 3 of them we still own, right? So basically almost 30 years later. So I had an early exposure to long-term holds. And then from there, I ended up starting the private equity firm that I've been involved with, was involved with for a long time.
Housatonic Partners?
Housatonic Partners. And I've been investing on my own in a family office called the Cromwell Harbor Partnership for about the last dozen years. So,
what a journey. And you also have some interesting board memberships, which you've also joined.
Yes, I have 2 public company. I mean, I'm involved with lots of private company boards as an investor in private companies over a long period of time. I have 2 public companies that I'm involved with in board capacities. One is a company called CNX Resources, which is an energy company, a natural gas business now. It's morphed into that, where I've been on the board for about 10 years. But weirdly, I've been the board chair for 9 of those years. And that's been an extremely fun project, working with the CEO there, a guy named Nick DeJulius, in implementing some of the philosophy and ideas that were covered in detail in the book. We can talk more about that. And then I'm also involved with a company called Perimeter Solutions, which is a leading manufacturer of, or producer and manufacturer of wildfire retardant for suppressing wildfires, actively, unfortunately, in use in Southern California right now. And I'm involved in that, on that board with Nick Howley, who's the CEO of TransDigm, and we are the co-chairman of that board, which is, has been great, great fun, very, very interesting in both cases. So those have been great learning experiences.
Yeah, and I also listened to a great podcast series you did a couple of years ago with the TransDigm CEO, TransDigm being one of the great companies out there. How did that relationship come about?
Yeah, so I've known Nick for a long time now.
Nick, the CEO?
Nick Howley, who's the CEO, longtime CEO of TransDigm. He's now the chairman of TransDigm and then co-chairman at Perimeter Solutions. And TransDigm just has this, I don't know, how many people here are familiar with TransDigm? Okay, so I don't need to repeat it. So TransDigm is sort of it's unique on multiple dimensions. It's a terrific business. Their game selection was excellent, so an excellent industry. But within that, they've designed a formula for optimizing per share equity value that's sort of extraordinary. And if you just look at the math of that, it's basically about a 30-year record since Nick was involved. Roughly half the time, it was owned by 3 different private equity firms. And the second half of the time, it's been a public company. And the compound returns over, again, I think it's 31 or 32 years or 36%, something extraordinary like that. But if you look at the 2 halves, the private equity period and the public equity period, the returns are the same for both, which is just that's a very unusual pattern. And they continue. So that's been an extraordinary company. And so we did a podcast in pretty great detail, more detail I think than most people were interested in. But we have one other that is coming out soon that's similarly detailed, but we're very slow as a result. It takes us a while.
Right, I can't wait for that. So let's get to the book. We've got a mixed crowd here. I would guess probably about 90% have read the book cover to cover 5 times at least, if not more, but probably 10% who haven't got a clue what we're talking about. So for their benefit, why don't you just in a few words just describe what the book The Outsiders is?
The book is it's a study of 8 high-performing CEOs. High-performing meaning they had exceptionally high returns, stock market returns. All the companies were publicly traded. They sort of needed to be over their tenures. And their tenures needed to be long enough to, sort of roughly 15 to 20 years on average so that we could see the data across 2 full business cycles. And there were two tests. They had to have returns that were better than Jack Welch's returns. When he was the CEO at GE, Jack Welch's reputation has been significantly and justifiably tarnished in the last 12 years. But when I was working on the book, he still had sort of a status as sort of a...
It's almost like a byword for the great CEO was Jack Welch.
Yeah, exactly.
It'd be a Jack Welch.
Formerly known as Jack Welch, yeah. But his returns were excellent. He had basically a 20% return for 20 years with, off in GE. So you had to at least meet that absolute threshold, and then you needed to have meaningfully better returns than the peer group over your tenure. And I think that second test is actually maybe the more relevant test. It's sort of this idea of duplicate bridge, right? So you needed to, basically the idea is that over long periods of time in an industry, everybody is dealt basically the same hand. And so if one company meaningfully outperforms the peer group, that's worthy of study. And so all 8 of these CEOs fit that pattern. And then if you, yeah, go ahead.
Yeah, and then the book is called The Outsiders, so why was it called that, and what were the common characteristics of these 8 CEOs?
So the personal characteristics, basically what's interesting is people would generally associate CEOs with being charismatic, strategic, visionary types. And those are actually not the adjectives you would use to describe this group of 8. Instead, you would use words like pragmatic, flexible, cool, rational, humble, data-oriented,
contrarian,
just a very different set of personal characteristics than you might think. All of them were first-time CEOs. So that might be the most surprising finding in the whole book. It does not get as much attention. But 8 for 8, all 8 of them were first-time CEOs. Anyway, yeah.
Yeah. And describe their track record.
Yeah, the track record's extraordinary. I mean, the range, the tenures varied, but they were on average about 20 years, so very long records. And the returns tended to congregate around 20% over 20 years, right? So pretty extraordinary in public market settings. There were some exceptions to that. John Malone, in particular, had a meaningfully higher longer-term return profile, partly because he was in a rapidly growing industry, the cable television industry, in the 70s and 80s and into the 90s. And so, but again, they were multiples better than the peer group, and many multiples better than the market in all cases. And then there was some very specific, their sort of approach to how they ran their companies was very different from the peer group, but very similar to each other, very similar across the group. And so some of the specific examples of that are that they did not typically pay dividends. They viewed dividends as being tax inefficient because they're taxed twice, as came up yesterday. They tended to very selectively repurchase their shares, and when they did do that, they tended to do it quite aggressively. They were sporadic users of M&A as a value creation device, and they had an excellent record in M&A, a very high batting average, so to speak, which is generally very much not the case for corporate America. And they tended to run extremely decentralized organizations, right? So I think one of the themes that's lost a little bit in the book is, I think it's a book about resource allocation, and there's sort of a framework for that relates to capital allocation. That's part of it. But if you looked at how they actually ran the firms themselves, they tended to have this bias for decentralization, and that means very few people at corporate, and the autonomy and prestige in the organizations pushed down into the local business units to an extreme degree. I'd say in half of the 8, they would be almost crazily decentralized, certainly relative to the peers. Yeah.
Do you think, I think the biggest takeaway for many people about the book was the role and the importance of capital allocation. Do you think that gets too much attention, or?
I think it gets the most attention for sure. It's very important. And it's interesting, I mean, having had this experience with these 2 public companies, I've had a firsthand look at how that works in public company context. Most of my investing has been in private companies over the course of my career. But I do think, yes, I do think the other sort of areas of resource allocation are talent and human resource, around that decentralization theme, and then actually the allocation of the CEO's own time turns out to be very important and not really focused on. But this group had a real bias for, there were things they just did not do. They typically spent almost no time on investor relations, little to no time on investor relations. They tended to spend a lot of time, scheduled time on their own calendars by themselves, that have actually slots of time. Buffett, of course, is famous for this, but where they were just reading or thinking or writing, often removed from the office. They just had different things that they did in terms of how they tended to have very strong COO-type number twos, who typically had oversight for the operations, these decentralized operations. So yeah.
And what has been the impact of the book for you personally, but also in the wider corporate world?
So for me personally, it's dramatically, wildly exceeded very low expectations. So it's led to all sorts of very fun, interesting interactions with both CEOs and investors. And that continues actually sort of to a remarkable degree. And that's sort of in North America, but also more broadly. I mean, witness this group here today. So that's been super fun and lively and interesting and surprising for me. And then I think it has had some impact on thinking amongst CEOs and in corporations. But actually, I think maybe less so than you might think. I think the core of some of these ideas. We were talking about this in a group yesterday, but I think it's a little bit like Buffett talks about value investing, where he sort of says, people either get it in the first 15 minutes or they never get it. You can spend days with them and they won't get it. It either resonates early on or it doesn't. I think that's very much the same with some of these ideas, particularly the ideas around capital allocation. In public companies, even if the CEO buys in, there's the hurdle of the board. You need to have the board also buy in, and that can be increasingly challenging as board sizes have generally grown in public companies. Not a good trend, in my opinion. I would say the two companies that I'm involved with, we've worked hard to keep our boards, by public company standards, quite small, sort of 7 or 8 people, which I think really helps productivity.
Yeah, sadly, that's been my experience as well. My impression is if someone doesn't, oftentimes you have a company with great business, makes lots of money, pays everything out as a dividend, and you're like, well, why not do a share buyback? It's much more mathematically, it's factually more efficient, but you very rarely change people's mind on that.
It's true, and this returning capital to shareholders idea gets talked about widely, but people don't really think about the mechanics of that. Yeah. They just want to check the box and be able to talk about it on interviews and in the media. But and even when they do make a decision to repurchase shares, the typical way they do that is they announce an authorization, usually with great fanfare, and they then execute it in the form of quarterly incremental repurchases, equal quarterly, which is not at all. If you looked at the 8 CEOs in the book, only 7 of them repurchased shares. Buffett was not a repurchaser at that time, the other 7. But their pattern was entirely different. They would wait long periods of time and do nothing. And then every now and then when the stock got really cheap, they would buy large chunks of it. Malone, there's a story of Malone during the GFC showing up at within one of his Liberty entities and having repurchased 11% of shares in the last month. That's a much more typical pattern for this group.
Yeah. So part of the rationale for this weekend is to help emerging managers. And as I was listening to you speak, you described all the incredible connections and things that happened when you published this wonderful book. And speaking to my friend Ted here, who has a blog, and he was telling me he brought him into connections with some interesting people. And for me personally, I think my letters were the reason that people got to know me and why probably everyone is sitting here today. So I think putting something intelligent out there and taking the time to write it is one of life's great hacks to get connected, right?
Yeah, I wish I'd discovered it earlier.
Yeah. So what happens when people understand how I like to invest, what kind of companies I look for, people tend to reach out to me and say, hey, you should take a look at company XYZ. You're going to love it. In fact, International Petroleum, I know several people in the room here, drew my attention to it before I invested in it. So thank you for that. But I can imagine something similar happens to you. So maybe you could share some of the companies which you've sort of discovered subsequent to writing the book, and which you might perhaps include in a second edition.
Yeah. Yep. So that's been one of the byproducts of those interactions, which has been very fun. So I think one of the interesting things I've discovered, or one of the learnings along the way, is sort of the power of these ideas in commodity businesses. And I think, Will yesterday, sort of was an exemplar of that, where in a pure commodity business like energy, and again, the company I'm involved with, CNX, is also, commodity energy business. I think having a sort of capital allocating philosophy of sort of long-term equity value per share optimizing philosophy is in itself a bit of a competitive advantage. And you can sort of see it in what I would call cyclical compounders. And I would put credit acceptance in that category, where they are on their own cycle in the industry. They get traded often with their peers, even though they've evolved an entirely different and much better model. But that provides them with the opportunities to massively repurchase shares during these recurring downturns. And there's another company in the US called NVR, which is a home building business, which is typically a terrible business, or not terrible, but a very difficult, capital-intensive, cyclical business. But NVR has a similar philosophy where they've evolved a capital-efficient model to that, so a differentiated model. But they tend to trade with the peer group anyway. And when there are downturns, they aggressively repurchase shares. And like credit acceptance, they have an amazing 30-year record. So those would be two examples. In the sort of serial acquisition world, the record that Nick has at TransDigm speaks for itself, but there are other analogs for that. Probably the best example and best known one, or a really interesting one, is Mark Leonard at Constellation Software. I'm sure many of you are familiar with him. Those who aren't, I would strongly encourage you to read his letters back to front, earliest days, to see the evolution in the thinking there. They're excellent letters, and they lay out a philosophy that's created sort of extraordinary value, continues to, like TransDigm's. So those would be a couple.
Yeah. Do you think letters are a powerful signal for a thoughtful outsider CEO?
It's a great question. I think they're the most powerful signal, honestly. I think that in the early days, when a new CEO takes over, like eventually you can evaluate the record, right? Ultimately, it's specific and quantitative, and you can evaluate the record. But in the early years, before there is a record, the question is what are the markers? What are the signals? And I think far and away, the most predictive one is vocabulary. It's the way the CEO writes and talks about their business. They get extra credit if they've evolved differentiated metrics, different ways of thinking about the business that they're in. At the energy company I'm in, as an example, and I'm not sure this is a perfect example, and we're early days still, we'll see how, but we're optimizing that business for free cash flow per share, period. And we're very clear about that. And it may be the only energy company in the country that's like, well, it's free cash, but free cash flow per share. I think that Will and the Lundins are on that program, but it's a large industry, and there are very few players who are. So I think metrics and vocabulary can be very predictive. Of course, you then need to see that the team is executing and following up on that vocabulary. But I think that's something to look for. Yeah.
Yeah.
Oh, I say extremely decentralized organizations would be another thing. Yeah. If you see that, that's an interesting signal. Yeah.
Yeah. And when we spoke a few weeks ago, you said you were toying with the idea to a follow-up to the book. Is it too early to talk about it, or can you give us a little sneak preview of what it might be about?
Yeah, so it's a bit too early, but what it's not going to be is just a series of other CEO profiles. I sort of feel like those ideas are in the original book. There are a couple of detailed chapters that I'd like to do, one on a nonprofit CEO, actually in the allocator space that I've done some work on. So I think there'll be a little bit of that. And then I think there's some related topics that I personally find very interesting, and so I'm doing some writing and thinking about that. Whether the audiences will, I don't know, we'll find out. But a lot of that around the idea of, I sort of described earlier my earliest investing, at Housatonic when I was in the closet, so to speak. And the fact that we still own I think really looking in detail at longer term holds and some of the ramifications and topics around that, there's some interesting.
Yeah.
So I'm going to spend some time on that, I think, and we'll see where I'm a very slow writer, so it'll take some time.
That's wonderful. So I think we've got about 10 minutes left, so I'd love to give the audience also the opportunity to ask some questions. So there's Claudine there. The microphone is on its way, just about the 5th row back. Just that.
Oh. Hi, thanks. You've partially answered it with the idea of how you identify when there isn't a track record. How do you know this CEO is going to be good and create that kind of value when you don't have a track record? So you've said that the thoughts that come through letters might help. But I'd be interested in, have you looked at any of the investors that managed to do that work and identify it and have ridden those stocks rather than seeing at the end how many people made that money other than the CEOs themselves?
Yeah, that's a great question. Yeah, I think there are, and they would I think be sprinkled around the room. I think there are a small number, a couple of handful of investors who have been on this program, so to speak, this philosophy, have been onto this philosophy early on, and have identified some of these companies in their earliest stages, and then held them across time. So there are examples of that. Let's see. So I think in credit acceptance, Tom Triforos would be an example of that.
Yeah. What an investor!
What an investor! He works with this company, this small. Nobody knows. Prescott. They have a quietly unbelievable 45-year record, and there's a lot of those out there, by the way. Quietly unbelievable records. Interestingly, they often migrate towards managing a small amount of outside capital to managing almost entirely their own capital, those investors over time. There's sort of a natural migration, I would say, often. But anyway, so there are a handful who have done that. And so.
What about sort of spotting the outsider CEO before there's a 10-year or 20-year track record? How do you do that?
Again, I think it's vocabulary. I think it's vocabulary. I think this serial acquisition area is a very interesting area for this. It's just now getting some, but there's sort of a pocket of companies in the Nordics that have been doing this for decades. Very similar philosophies, surprisingly so. There are parts of the playbook they don't implement. They don't tend to repurchase shares the same way. There's the different, but in terms of their per share value creation over time, it's been extraordinary in very decentralized structures. Around serial acquisition, different approaches, and they come off of sort of a family tree, a coaching tree. This company, Bergman and Beving. So yeah, I think there are some examples.
Perfect. Is it Carlo? I think.
Yeah. So I'm curious how decentralized cultures can be maintained through decades of extreme growth, perhaps outside of the serial acquire model, where it makes a little bit more sense. But these companies tending to pay people much more than average, are they attracting people who are very into the kind of non-hierarchical culture? I'm curious how you see that evolve at these companies.
Yeah, it's a great question, and I think that's a very tricky thing, right? The transition from the founder, who implemented the culture and inculcated the culture, and how do you retain the essence of it going forward? And I've seen that in situations where it has worked, and where maybe it hasn't worked as well. In the situation where it's worked, in every case, been one exception, but in almost every case, it's been insiders, people who had been working closely with that predecessor, founding CEO, were part of the core team. Was talking with Daryl at Trupanian, and it sounds like he's got someone who fits that profile. Maybe not in the decentralized model, but more generally his approach. It's harder with outsiders. It's harder with people coming from outside those cultures. And even with insiders, so to speak, it's not a given. So it's challenging. But they are very powerful cultures when they're fully implemented, and they tend to have exceptionally high talent retention. It's one of the characteristics that you sort of see across those groups.
Right at the back there.
Hi, well, just had a question. You've been involved in search funds for a long time. How do you go about hiring people who might show traits of these outside CEOs?
And when you say hire, do you mean in some of the private investing that I'm doing?
Yes, but also just thinking about what sort of context or what sort of training that creates these type of traits.
Yeah, that's a good. I mean, if you look at the backgrounds in the book, using that as an example, it's kind of interesting. I mean, out of the 8 CEOs, there are more engineers than MBAs. There are 4 engineers, only 2 MBAs. And I do think there's a quantitative crispness around a lot of the CEOs in the book who fit that profile, and I think that's true across. Nick Deulius, who I'm working with at CNX, is an engineer by training too. So I think there's some of that. In the private companies I'm involved with, it's a slightly different set of characteristics that I look for and we look for. But I would also say across all of those, a characteristic is crispness in communication, both written communication and verbal communication. So long-windedness, there are very few examples of long-windedness correlating with these attributes, is what I would say.
So much wisdom, amazing. Who's next? Matthias at the front.
There's one here.
Sorry, one at the back, and then we'll take you next, Matthias.
Hi, thanks for sharing your wisdom with us. My question is about which part you find the most challenging in writing the book, which characteristic might be more challenging to explain to investors when reading your book?
I'm sorry, could you repeat the question?
Yes, which part you find the most challenging, which lesson you take out from that?
What do you find difficult in writing a book, and which countries do you have the most problems explaining to people the ideas in the book?
Okay. So the writing of the book is part of it? Yeah. So that basically, it took me a very long time to do that, as I said, sort of a year per chapter, which arose from the way I did the research and the people I worked with in the research capacity, which we could spend some more time on. But it took me a long time. In terms of the ideas in the book, that's a good question. The book has been translated into 17 languages, I think. It's going into Farsi soon, I think, so, which I'm quite proud of. And I think I guess the area that I haven't seen it, Japan would be an area where interestingly, there's been some interest, but again, relative to the size of that economy and stock market and really entrepreneurial culture, surprisingly less so than you might expect. The Nordics would punch above their weights. Yeah.
Matthias.
Hi, Will. I have a question with regards to your experience in private and public investing, which is quite unique. I think most of us are more on the public side, and I think we can learn a lot from the private side as well. So actually 2 questions. One question is, which game would you suggest, especially for young investors, to choose between private and public? And then the second question would be, what are the things we on the public side can learn from private investing?
Yeah, good question. On the game selection question, I think I would say public market investing because it's easier to, it's not easy. But the ideas are broadly available, and it doesn't require deep networks of sourcing. It's just hard to get in the game of buying private companies. It takes a lot of time. There's an upfront cost to that in a way that there isn't in public markets. And in public markets, you can get crazy disjunctions in valuation that you just don't have in private companies. Owners of private businesses just generally are much more rational in how they think about valuing their businesses. So you rarely get in, I've had a couple of conversations this weekend of, businesses that are trading at, 25% of the value that they would, understandably achieve in a well-run private auction. And you just don't find those sorts of disjunctions. So I think that's an easier game in that sense. Not an easy game, but it's an easier game. And then I do think it's a little bit like that Buffett expression about his experience as a CEO at Berkshire made him a better investor and vice versa. for me personally, that's been true in my private investing and my public market investing. There are sort of learnings from both sides that I have been able to apply to the other in ways that have, I think, improved and altered, enhanced my approach over time. So I think that cross-fertilization can be very powerful. And again, it goes back to the investment group of Santa Barbara, which is this group with an amazing record out in Southern California. It started in the public markets and evolved into private investing, more on the venture capital side, but their learnings on both sides of that continue to inform the investing in the other, and have, in each case, produced interesting edges for them versus peers.
Okay, we have a couple more questions. Carlo?
How do you manage your agenda and your space of mind between your public, your private investments, your board seats? Like, tell us a little bit about how you manage your time and how you think.
Yeah. I'd say I'm doing it. I'd say not perfectly would be the answer. The problem is that I like all of those activities, and I'm continually trying to concentrate my portfolio of time allocation, and I'm doing I'd say a B- job at best in that. But again, I really like all, and there's a lot of, the board seats consume a lot of time, but I really enjoy those. The 2 public company boards, and I'm involved with about 8 private company boards. But I also love continuing to look at new investments, and so it's a constant, and there's some nonprofit activities that I'm doing more of, and so it's a constant struggle to figure out the right allocation of time. But I'm over 60 now, remarkably, so I've really made an effort in the last sort of 18 to 24 months to concentrate that portfolio, and I'm hopeful 24 months from now, if we were sitting here, I'd be better than a B-, but I'd say at the moment I'm a B-. Yeah.
Well, you're doing very well for a 60-year-old. So who would like to ask the last question? Andrew?
Yeah, so I feel like in the fund management world, there are a lot of people that learn how to talk the talk of being the next Warren Buffett or Rob Vinall. But in the corporate world, I'm sure you see the same thing. Are there ways that you've seen to spot maybe, like, for lack of a better word, pretender, or somebody who's just saying and pretending to do the right thing?
Do you mean amongst investors or CEOs?
Amongst CEOs, or whatever you have more experience with, either side.
Yeah, I have more experience with CEOs, I think. I mean, again, I think it comes back to, can they crisply communicate their edge in their industry? And do they think in terms of per share value creation? Like, literally, if they use those 2 words consecutively, they get extra credit. Really. And so it's not, it sounds flip, but it really is a simple filter that I think is very powerful. Yeah, I do.
Yeah, once or twice was asked in the past, like, if someone writes like a 20-page, very thoughtful letter, are they pretending to be a thoughtful CEO? I'm like, well, they probably are a thoughtful CEO if they're... Will, this has been incredible. I've studied everything you've written and spoken so deeply, and yet I still learned so much today. I think the 2 really big ideas which I loved was resource allocation, not just capital allocation, and maybe the opportunity to apply these ideas more fruitfully to cyclicals as opposed to the wide moat companies that people typically go after. But this has been truly incredible. Just before I allow you to give Will a big round of applause, one final question. A number of people have asked me they would love to get a signed copy of your book. I'm sure you don't have 200 hard copies in your suitcase. Would it be okay if they send you a return envelope? And
absolutely. And again, Rob, thanks. Great to see you and great to be here.
Perfect. Thank you so much. Okay, coffee break. See you back in 20 minutes for the next panel.
Oh, that was fun. Thank you.
My favorite one I've done so far.
Oh, yeah. It's such a lively group. I mean, I've had so much fun. I've made an effort to sort of reach out to people I didn't randomly go up to people here. And again, I'm following the cheers you have created amongst just like-minded, just sort of kindred spirits. Really remarkable. fact that you're not, it's sort of this idea that you don't have a specific objective. You're not trying to raise the happen. But things just sort of happen out of it. You know, I whether it's ideas, days, and our relationship. So anyway, I hope that continues. Hi.
I had once lunch with Tim Bliss.
Oh, you did?
Yes,
oh, yeah.
and Barbara. I was impressed.
Oh, he's great. He's really great.
That's a group of stuff. Barbara is outstanding.
They have a remarkable record, and they're wonderful human beings. Hi, I'm Will.
Hello, Georgi. Nice to meet you.
Meet you too.
I had a question for you, but we ran out of time. I was wondering if you could take it.
I'm going to go over there.
shared idea.
Can we do it afterwards? Maybe
Yeah,
because I have to.
go.
There'll be more time.
Yeah, I'll give it to you later. Thank you so much.
My pleasure. Thank you. So you're going to stand here, and then you'll have the three.
Because were there any tables last year? And I stood here. Yeah.
Great, you were wonderful last time. If I don't get to say well done because I've got to dash, I've got to leave here at... What time is your... 10:30? You're all set.
entry point to understanding money. But already during my studies, I was working at kind of like the intersection between finance and sustainability. I wrote my thesis on financing the green transition in the US. Then went into consulting, mostly around sustainability, environmental sustainability, consulting, governments, large companies. Then went to the World Economic Forum, again working on how to finance the transition to a circular economy. But it never felt like this is it, right? I had this weird feeling that I'm doing something meaningful, but this is not where I'm supposed to be. And then, I think New Year's Eve, a couple of years ago, a friend of mine, Jan Moore, I think some of you know him, now CEO of Chapters, we got to talk. And he was at a point where I said, I'll make a lot of money, I want to do something meaningful with it. And basically we said, we both believe in the power of entrepreneurship to change things. And he said, well, if you're setting up a company or something in that space, I'll be your first investor. And that's how I kind of like got into entrepreneurship and then investing. And fast forward a few years later, I set up a company called UNCAP. And under UNCAP, we have Unconventional Capital, which is an investment fund investing in small and medium-sized companies in Africa. And also a software company called Level, providing operating systems for fund managers. We are the first and biggest client, but now adding more and more clients since we started.
Great, Cynthia.
Sure, good morning. It's great to be here, and thank you for having me, and thank you for leading this panel. I am Cynthia Masri. I'm a managing director at Trinity Church, which is an endowment in New York City. But in terms of my path and career journey, I was quite interested in capital markets, and I think probably investing from quite early. I think partly that was a function of, I was born and raised in Tokyo, I'm half Japanese, I grew up going to an international school, and I think through that exposure, that developed kind of an interest in thinking about, how do countries interact with each other, thinking about geopolitics and regulation, and then even within that, how do companies then have, kind of in particular multinationals, operate within those frameworks. And so I was interested in global markets and thinking about kind of macro flows, whether it was even just dollar yen and why do currencies moves and interest rate differentials. And then quite fortuitously, because I didn't know what to do that in terms of how does that translate into vocation or career, I ended up going to university in the States, and the university I chose was a bit of a kind of feeder onto Wall Street. It is a very finance-focused school, and so through that, and whether it was professors and courses and clubs, I started learning a little bit more about Wall Street. And frankly, that was on the on-campus recruiting in the presence of a lot of the investment banks. And so through my years at university, starting to understand, okay, here are different functions within an investment bank, and the one that interested me the most at the time was sales and trading, because that was very close to the pulse of the market. And so my first job out of school was working for Goldman Sachs in New York. I worked on the public market side doing public equities on the trading floor. And I ended up leaving to go to California. I went to Stanford for business school for a couple of years, and then returned to Goldman Sachs, this time in London, where I started working in the principal investing group. My function there was more so on kind of Goldman's balance sheet investments, primarily on the real estate side, whether it's on the private equity side of buying large portfolios and platforms, or on the special situations side and non-performing loans, given some of the market opportunity we saw there, until ultimately 7 and change years ago, I moved over to Trinity Church.
Thank you, April.
I'm a Chinese American immigrant, and then when I was in high school, this is a school that started by 6 or 7 Chinese American veterans from the Wall Street. And I was very luckily the second class that they had, and we only had like 30, 40 kids. So that was how I was introduced to stocks. And they had like an economics class in the final year of my high school. And that was at the end of 2007. So during my paper trading, I thought I was a genius. And comes the second half of my senior year high school, it was 2008. So I lost real money for buying Baidu. So I always wanted to get back to it. So that's how I got interested.
Great. Cynthia, you briefly mentioned Trinity Church, and I think this is a great opportunity for all of you, but Cynthia, you can start to talk about the business and the role you're currently in.
Sure. So I work for Trinity Church, which, as context, is a historic church organization in Lower Manhattan. The background is Trinity was founded in 1697, and then in 1705, the Queen of England gave the church 215 acres of Manhattan, which ended up proving to be quite a valuable gift. And so subsequent to that, the church ended up either donating or monetizing a lot of that land. But today, if you look at our endowment, about 40% is still in direct real estate. So we are a fairly large asset owner and landlord, commercial property in New York City. And then 60% of it is in what we call the securities portfolio. That's more the typical allocator model where we as LPs invest in funds, including with Rob. It's diversified across geographies and asset classes. And more recently, we launched another portfolio called Mission Investing, which is our impact investing portfolio with the intention of investing in areas that Trinity already does a lot of philanthropy, or what our mission areas are. So in terms of my role, I work across the endowment. I serve on the board that oversees our direct real estate. I manage our impact investing portfolio, and then I am a generalist on the securities or the allocator side.
Great. Francisca?
So I'm CEO and founder of the company. As I already mentioned before, so Unconventional Capital is an investment company. We have around 90 portfolio companies, so 90, and we provide revenue-based financing to early-stage SMEs, so small to medium-sized companies. Revenue-based financing is not a very common concept in Africa, and I think also generally there are a lot of challenges in providing that funding to companies. At the same time, it's urgently needed. So around 10% of SMEs can access financing at the moment. And so we mostly look for companies that have the potential to grow, obviously, into a medium-sized company. We like companies in agro-processing, so that's also currently the deal we're looking at, and also things along the lines and around that, like logistics and financial services and agriculture. And it took us quite a while to kind of like figure out how to actually do it, because there is no blueprint in doing it, and you also need to solve a lot of problems outside of your main investment, right? You need to solve for how do I underwrite a company without transparent data and lack of data? How do I collect payments without a functioning credit score that incentivizes repayment? And all those experiences that we made over the 90 investments we've done over the last years across 7 different countries, we've built a operating system for ourselves. So we felt like the only chance we'll have to make this work, especially in that ticket size that we're playing, which is below 100,000, we need to be highly efficient, right? We need to streamline as much as we can, and we need to automate as much as we can. So we've built a software originally for ourselves that just helps us end to end from the first point of contact with an entrepreneur to the last repayment, kind of like trying to automate everything we can, reduce admin and free up time for the team to focus on the touch points that I needed with the entrepreneurs. Seeing that there's a gap in the market, there's a need in the market from other fund managers and companies in the same ecosystem, like accelerators and incubators. We started offering that software as a SaaS last summer as well.
Thank you. I think it's so amazing how broad the industry can be. We have a church, we have investment in Africa. April, what about you?
I'm a fund manager based out of Hong Kong. I started Age Over 4 Pi February of 2021, which is literally the peak of China markets. And we managed to grow since then for the past 3 years, despite China is down 45% from where it was. And I think how I got started was initially I worked in investment banking for 2 years, and then I moved on to special sits investing at Goldman Sachs. And then I got to know Mr. David Ma, who started Composite Capital, and I joined him from day one. I worked there 4 years till he decided to sell his business to C Limited. And I was really trying to figure out what's my next move after that experience. And my style has developed into very long-term fundamental investing, concentrated bets, China, which limited my kind of opportunity, or very small, limited number of funds available that I can work with. And I think it was till end of 2020, early 2021, then I figured out maybe I needed to do it on my own. And then we very quickly, within 2 months, put the money together and opened an account literally at the market peak. And that's how I got started.
Great. About the topic of access, maybe to the industry where you are now, what are some challenges that arise when you got started? April, maybe you can take the question.
How I got started with investing early on, or how I got started with the business?
Maybe with the business.
With the business? It was very hard from every angle. You have to convince people that you have the ability to invest. You have to convince people to join you. You have to open accounts with prime brokers that think you're never going to grow. You have to deal with capital allocators that require at least 2 years of investing track record to believe you can do anything. So I think every angle is difficult. So how I dealt with it was, I think I just need, so my mentality has been always like, I don't need everyone to agree with me, but I just need the one that are kind of buying into what I want to do and believing what I can do, whether it's with investors or whether it's with potential analysts or employees. So I got pretty lucky. I had 60 people that were my former colleagues or friends or family that were interested in investing with me and put the money within 2 months. And we were able to get started that way. And then I have 4 people that I knew from day one before, in my previous work career that want to join me for like no base salary for like almost a year. So that kind of left me with a very low carry cost for the business. And there were no institution with the business. So then I didn't have the pressure to have to deliver every month. So my time horizon for investing become much wider and longer. And everyone that signed up with me from day one had a lockup term of at least 3 years, which takes me to today. And now they're happy, so they're not leaving.
Great to hear. Cynthia.
I guess if the question is in terms of access to the industry, I feel quite fortunate because perhaps I have more of a traditional finance background, and so I think through, going through the typical training programs as an analyst, that was quite easy once you were in the door. But as I look back on the beginning of my career and some of the challenges, I think come 2008, I was working in New York for Goldman on their trading floor, and I think while it felt incredibly challenging at the time, it probably has left some of the biggest impressions in how I think about as an investor going forward, and to almost look at it as fortunate on having the vantage point of being very front and center as a participant and as a witness of just the unraveling of what happened in the great financial crisis and some of the lessons learned from that, whether it was from the market volatility or on the more human side in terms of leadership.
I think for me, actually, because I'm more like an accidental investor, I kind of like fell into the industry by accident, wanting to solve for a problem. Generally, the start, in hindsight, was much easier than growing the company. And I think that's due to kind of like having that first anchor investor that believed in the idea, and also was able to pull in a few other investors early on. However, so we're investing in Africa because I think next to climate change, Africa is the biggest issue, and you can call it challenge, opportunity, it's probably both, for the next 30 years. In climate change, there's a lot of money going into it, which is needed. But in Africa, it isn't, right? It's still widely neglected. I think 0.5% of private equity goes into the continent. At the same time, the population is going to double, 2.5 billion people by 2050. Every fourth person on the planet being African, 42% by 2060 being middle class. That's an insane opportunity, right? That I think especially in Europe, very often we can't really grasp it. And at the same time, we see that that opportunity really needs to be harnessed. And at the moment, it's not the case. And the only way we're going to do that is by creating jobs for the 800 million people that are gonna need jobs for the next 25 years. And those jobs need to be created by companies. That's not surprising. And the highest labor productivity you have in medium-sized companies. But you need to be able to grow your company to that level, right? And companies hardly have access to finance. So you have that, so you're looking for investors who see the opportunity in the long term, but also see that in the short to midterm, you need to overcome a lot of challenges to get there. And it's a sweet spot, right? There are not a lot of investors out there who see it like that, and who can also balance that kind of like ambiguity of maybe in the short to midterm, it's more like an impact investment, right? I'm supporting a company to develop a potential solution to a problem. And either it's a huge learning experience that will inform the rest of the market, but it will not be the one who's actually winning in that game, or it will actually be able to benefit from those early learnings and become kind of like a huge investment fund over the next 25 years. And then you also need to have an interest in Africa to begin with. And so I think I've talked to like hundreds and hundreds of high net worth individuals over the last years. And we had some good success in fundraising, but it's just kind of like a tiny percentage of what we need. At the same time, the other investors are the foundations and the development banks. And they are obviously investing with a very different angle, right? And so we've just got money from the Bill and Melinda Gates Foundation, which is fantastic. It's a great name, great credibility. At the same time, that money, of course, comes with very different strings, right? They're very interested in what are the KPIs you're meeting, what is kind of like the ultimate benefit to the consumers of the companies you're investing in. And so you're kind of like pulled between we want to go the commercial way or we want to go the impact way, but you need to play both games because you will need both funding sources to grow your company.
Very briefly, why do you believe there's such an oversight of Africa's opportunity?
I mean, there are other opportunities, obviously. And I think also generally Africa has had a very mixed path over the last 25 years. Just last week, The Economist brought out a new report about Africa. And the report, I think, early 2000s was about, oh my God, this is horrible, this will never work. 13 years later, it's like, okay, this is like a hidden champion, this is a fantastic path, there was a lot of growth happening. And then that growth slowed again, right? So overall GDP growth was pretty flat, although 9 of the 20 fastest growing economies are in Africa. And then you hear these different stories, right? You hear horrible stories from one country that you automatically then start to portray to the rest of the continent. So I think if you want to invest in Africa, you need to understand what you're doing, or invest in people who understand what they're doing. And you need to be able to, in your head, balance those different stories that you hear between, yes, there are challenges that you need to overcome, but there are also opportunities. And both things can be true at the same time. And that, I think, is for people who have not a lot of time, a lot of interest to invest that time into understanding Africa. It's just not on the top of their priority list.
Okay. The last question from my side before we move to the audience would maybe be to just quickly describe your investing philosophy. Maybe Cynthia, you can start with that.
Sure, and I think, fundamentally, whether types of investments and asset classes you're looking at, there's a lot of things that hold true in terms of investment philosophy and framework. But I would say when you are in the seat of an endowment, I think the goals of that organization and the use of that capital certainly does influence your investment framework a lot. And so to put in the context of Trinity, it's a church that's been around for over 300 years, and the intention for the endowment is for it to continue to be able to have its ministry for the next 300 years and frankly into perpetuity. And another relevant angle to that is perhaps unlike other endowments that have other revenue streams, whether it's from tuition from students or health bills and payments, for the church, the endowment is really the sole source of revenue. And so that does influence the way we think about the endowment and managing that kind of risk and return. And then lastly, it's very unusual for an endowment to be 40% in one asset class, in particular, indirect real estate, where it is very concentrated in terms of sub-market, sub-asset class, and then illiquidity. And so that certainly also influences the way we think about the entire endowment. But with that being said, I think, ultimately, and perhaps I'll focus more on the allocator side versus if I'm looking at originating a loan or a direct deal, given the fact that I think a lot of this audience is emerging managers or fund managers. And so on the allocator side, while of course we are diligencing and thinking about the underlying companies and exposures and your investment strategies, and that's highly important, ultimately we are also diligencing somebody else's investment process and somebody else's investment decision making. And so there are different elements to it in terms of thinking about, okay, well, how is this organization situated? What do the employees look like? What is the incentives and how are they aligned with us as an LP in particular as we think about, what does that mean for risk tolerance? And then with the overlay of thinking about, okay, the entire portfolio, how do these managers potentially correlate with each other and the underlying holdings? And so maybe I'll leave it at there in terms of how we think about things.
Thank you. April?
I think there's a bit of evolution in terms of how I think about investing and my strategy. Initially, it was just buy and hold and ride with the good business and just it's very Warren Buffett, like the kind of younger Warren Buffett style where you just wait for the quality business to take you to the next level and ride with the growth. And I think later on, as China market has become more difficult, I coupled this with a very stringent investigative fact check system where I diligence and try to figure out what's going on with the business as an outsider instead of talking to the management through an investigative way to understand what's going on with the business in terms of understanding its business momentum. So that layer on top of the quality business growing for a long time, high ROE, good asset allocation methods by the management. So there is a bit of evolution in terms of how I invest. That being said, I don't know, because I'm still young, it could be not stable and I might evolve into something else, and I'm excited for that.
Franziska?
I mean, I think I already kind of alluded a little bit to our investment philosophy is obviously very different from most investment philosophies in the room. We're only investing in private companies, ticket size below 100K, and we do revenue-based financing debt. So we provide a certain, let's say we provide a 100K investment. There's a multiple on that investment that the company needs to pay over a period of years, and the monthly payment is a percentage of their top line revenues. And we do that because Africa's markets are not very liquid. And you hear that left and right. And I think that has also contributed to seeing the capital markets as something that's not working very well. Because getting a company to an exit or a sale was just very hard. So we decided from the get-go, this is one challenge we do not want to have. There will be enough other challenges, but this one we don't want to have. So we're, as I said, mainly looking for companies that can grow over time, where we see that they're in an industry, they have a management, and they kind of have an edge to other companies that will enable them to grow over time. But we also need to underwrite for behavior. And I think this is where investing in Africa is quite different, because there's, as I already said, lack of data. So you really need to figure out not only will this be a company that has substantial growth, but also will this be a management that is actually will kind of honor the contract that we have. And so we are more and more looking at behavioral metrics. So we started out actually doing psychometrics. So we've designed our own tests and things like that, but we're now more and more looking for external signals that this is an ownership that has upheld obligations before. And it doesn't necessarily mean it's a loan, right? Many of them, we're the first external investor. But it could be that they're just seen as someone who has had an obligation before. It could be as part of a training program, could be as part of a community, could be towards their buyers or their suppliers. But they're someone who generally, is kind of like honoring contracts. And then the second part we're looking at is like, are they operating in an economy where we can lock into systems that will make it just a little bit easier to kind of like collect our repayments. And what also is like our proximity to the companies and to other partners in the ecosystem who will have information about that company. So that's why we tried out different things. We're now narrowing onto East Africa because most of my team is based there. And we also see like some of the faster growing economies in Africa are in East Africa. So that's what we're kind of like going with for now.
Thank you very much. And on that note, I would like to open the floor for questions from the audience. I don't know if we have the microphones ready to go.
What's the first question at the back there? Chat with the red jumper.
Hello. Is there anything about being a woman in finance that you wish men in finance understood better?
If anyone wants to jump on that.
I think generally, if you're, like very often there's a question, so what's the edge being like a female investor? And I don't think that there are that many differences, but I do think that there are like personality traits that we see as more female or male. But both genders probably have them. And I think we were just more trained to show certain traits and kind of like neglect others. But I think if we were listening to Rob talking about it yesterday, we heard a lot about emotion, having your emotions in check, balance, family. I think those are traits that you would probably a couple of kind of like decades back would have seen as much more female than male. So I think generally it's more about seeing how, if you're playing to both of those personality traits, you will just generally probably have a more diverse and holistic view. And I think, first of all, that I think is important for everyone in the industry to understand that there's not, this is a female investor and this is a male investor, and they're fundamentally different. I think generally when it comes to more like access or opportunities for female investors in the ecosystem, obviously role models, right? I think this is kind of like everyone, and I think everyone here in this room will have their role models that made them who they are. And it could be Warren Buffett, could be kind of like CEOs from the outsiders. So they're kind of like role models that that basically formed your path to becoming an investor or a CEO. And we do not have a lot of those role models. So I think, first of all, things like that, like you need to put female investors, you need to give them more spotlight. And then second, probably, which is more in private investing, but also probably in fundraising, like networks. Right? Like how are networks being built? Who is in your network? And also like how might you lose out on that network for a while if you're a woman who decides to maybe have a child and you automatically need to step out most of the times for at least a couple of months. You will lose out on a couple of conferences, and also generally it will get a little bit harder for you in the future. So like thinking about how can I, as a male investor, make sure that I'm integrating the female investors I know, or I don't know yet, so then you should probably try to know more of them, into my network to make sure that they have kind of like the same exposure to other investors, to potential LPs in their funds than myself.
Do you have anything to add?
Sure. I mean, I think it's an interesting question, and I think, you know, the reality is I don't think that it necessarily needs to be so differentiated between a female investor and a male investor, because all of us are balancing so many different facets of identity, and it's not like we're showing up to everything as a female investor, this is the stock that I think is interesting. You know, it's not really that cut and dry. But what I think perhaps we could better do as an industry is also think about everybody is wearing multiple hats, and everybody has different things that they're balancing outside of just what their job and career is. And so if I make it personal, you know, one of those things I balance, I have 3 kids. So as a mother, what I think is helpful is when it normalizes a little bit more workplace integration. And I don't think that has to be because it's a man or a woman who's doing it. I really appreciate the first time I came to this conference 2 years ago, the fact that Rob includes his family. I think that's a great precedent to be setting. I think it's probably also really nice for Rob that he gets to spend the long weekend with his family, and it's probably great exposure for you to be able to even have this sort of access. And so whether it's because you have that role, maybe you have the luxury of managing your own company, but if you don't, maybe it is that you know, you are managing a team, or you can think about a larger company in ways that, not just for a working mother, but it's also working fathers, on thinking about how can we normalize it and make it a little bit easier for this integration. And perhaps, you know, giving an example of a kid is home sick from school, instead of does everything need to be in person, or can this become a phone call? Or if it's a video call, is it okay if there's a child in the background? Is it that big of a deal? Obviously understanding that not every circumstance is like that, but I think the more as an industry, we work to recognize that everybody has a lot of different things and identities that they are balancing, and to be able to integrate that more, I think would be great.
I think of a little bit as a competitive advantage between male and female. Because to be a successful woman, you can be a successful mother, you can be a successful wife, you can have a successful career. There is more multifaceted than a man whose identity is more tied up to the career than a typical woman, just by societal arrangements, I think. So it's kind of a little bit unfair for men. So I think if you're in the business of investing, I think as a woman, I'm really here investing just purely because I like it. Told my husband I'm not gonna be contributory financially for my family, like you deal with everything. Okay? If my business don't make money, it should be understandable, you know. So like, okay, by default, then my manager don't have to be, you know, profitable. So you can allocate more resources for your diligencing and your analyst or whoever that's in the game to make everyone happy. So I think that what we are solving for is a little bit different from men, which I think at the end, it's really about, are you really interested in this? Instead of, I have a 3-year-old son, instead of spending time with your son or spending time with your family. So I think it's about what really makes you a happier person at the end of the day as a woman. And you have to be really honest with yourself. I remember after me giving birth to my son, that was 3 years ago as well, I was really bored at home because, you know, in Chinese culture, you can't go out for a month. And I was like, but the second week, I'm like, I need to get my nails done. If that's something that really makes you happy as an individual, you should just go and do it. I tend to think actually women have more freedom than men in choosing what they want, versus a man's success is more defined by the career identity.
Okay, very interesting perspective. No, I like it. We have time for one more question.
This question was for Cynthia on the New York City real estate portfolio. I guess one is, does that portfolio, how does that work? Does that cash flow back to you all, or is it purely illiquid? And then two, is it mostly, I'm assuming, office? And I guess what are you guys seeing on the ground these days?
So it is primarily, and by asset, it is developed office, what we would define as Class A office. We do also own some land that is yet to be monetized. We also have a couple of deals that are in the process of development. And so based on that profile, the cash flow differs. But I would say because we already have 6 million square feet of office, that is largely cash flowing. And the way that it works is ideally that then goes to reinvest in the real estate portfolio. And ideally there's excessive cash flow that can then come and go move into the endowment. Normally we have dividends come out of it. The reality is that I think office has been very challenging, and I think that's true as just structurally across the nation, but then also in particular cities in the States, New York included, I would say probably only, behind San Francisco and a handful of other cities. So in terms of how we're managing and we think about it, one of the luxuries that we have, it's very low leverage, and so we are not in this kind of acute crisis of we are going to lose the buildings. I would say the way that we structure everything is that Trinity retains the fee or freehold, and in the case of a lot of our office, we are the majority equity owner. We own 51% of the leasehold. The rest largely is with Norges, which has been a great partner in terms of their profile and the Norwegian Sovereign Wealth Fund. Look, it's really challenging. I would say that our physical occupancy in that building still, in a lot of those buildings, is still only at 50%. Now that's very different from our actual collection. I think it will be interesting to see as leases roll. What is challenging about office is that there is so much bleed between NOI and your cash flow, and it is a highly intensive kind of capital asset. I could go on forever about office. I'll take it offline. I have a lot of thoughts about it.
Thank you very much to you three, April, Cynthia, and Francisca. And I believe we'll be back at 5 past? Okay, 5 past. Thank you.
Amazing. I'm not sure if I finished it 5 minutes too early today, or was that the right time?
Yeah.
I think it was supposed to be 40 minutes, right?
Yeah. I think in the program it said 45.
10:45 we finished.
Yeah.
Okay, so that was bang on time.
It was good. I was so funny the first question had to do about.
Amelie, hättest du nicht noch 5 Minuten länger machen? Das ist doch Viertel vor erst.
It's my. I told you the last question, so it's totally fine. But it was quite a short question, so.
It's fine. Who's the lady?
Just in case I don't see you, because I know it will get really busy. So
yeah.
this is excellent.
Yeah.
I've had very good conversation with lots of people.
Yeah.
So we'll see what comes of it.
Yeah, I hope something else is different for you. But in any case, I'm sure it was a fun weekend.
Oh, it's fun. Yeah, it's good to exchange ideas and hear what everybody's doing.
Yeah.
So you have a very good following.
Yeah,
Which is excellent. It's good for you.
You're always welcome back.
No, I'll definitely make time to always try and come back.
Yeah.
Something from Nairobi?
Oh, you're so kind. Thank you. You know I'm a big coffee fan.
I know. So you have the 2 coffees, and I know last time you forgot you carried your peanut butter. So peanut butter from Nairobi as well.
Well, thank you. That's so kind. You're really kind. Thank you so much. Yeah.
And then I'll try and go up after. I'll try and go up the mountain.
In that case, let me give you a.
So you give me. So do you know anything to me on the way out?
really, really great to have you.
I know that it's very good touch. And then the last
Great concert. I really enjoyed it.
Yeah, my wife said she enjoyed skiing with you yesterday.
Yes, it was really nice of you.
You're very welcome.
Thanks a lot.
My pleasure, yeah. You're leaving afterwards, or? Okay, if you'd like to sit down, and I would also request my panelists to come up on stage. Yishin, Fred, Graham. Oh, you're all close by, that's good. Please grab a seat.
How do we want to sit?
Yeah, just give people the opportunity to find their seats, and then we'll get the final session up and running. You see how many more people are trying to get in. So please come in. Welcome, welcome, welcome. Next session is about to start. Everyone's outside enjoying the coffee. Okay, I think I'll start with a few introductory comments, and then we can introduce the panelists when hopefully everybody is already inside. So this is the first time we've done a topical discussion. In the past, it's always been different sort of groups of emerging managers and endowments and family offices and that kind of stuff. So thank you for joining me in this little experiment. And I think one of the most sort of pressing questions or interesting questions for investors today is, what to do about China. Everybody sees the economy as incredibly successful. It has these great companies, very, very cheap valuations. But on the other hand, there's Trump and there's Taiwan and there's the experience we saw vicariously with Russia over the last few years. So I think people are sort of trying to figure out what to make of this. And so it's a very topical question we have today, and I'm really looking forward to the discussion. I've got 4 panelists here who I'm about to introduce you to. All 4 were very keen to point out they don't view themselves as China experts per se. They don't spend their entire life thinking about China or that. They're all 4 first-class global investors, but who have, and as they will surely explain, there's certain amount of exposure and time they've spent in China. So I think the expectation should be a sort of a big picture view of the country and views of the country, as opposed to someone who's sort of people who are super deep into the weeds of China. In terms of the question that I posed at the start is China investable? That was, of course, meant slightly provocatively. Of course, any asset is investable at the right price. I think there was an analyst last year who said something along the lines of that China is uninvestable, and what does that mean? If you were offered the entire stock market for $1, would you decline it? Of course not. So everything is a question of price. So we won't go too far down that road. But there are issues and pros and cons, and so that's definitely what will be our topic today. So with those introductory comments, I'll ask each of you to briefly introduce yourself. Maybe you could tell a little bit about your funds and what your relationship to China and Asia is.
Sure. Do you have one? I don't. Good morning, everyone. My name's Graham Rhodes. I'm from Hong Kong, was born and raised there. I run an investment management company there called Long River. I invest in public equities globally. It's really quite an honor to be here. I've been watching these events on YouTube since 2017. And with a few friends, some of whom are here today, like Andrew Burns, James Ferguson, Carlo Gioja, we actually took the inspiration from this event to start one in Hong Kong, which is where I got to meet Rob last year. And let me tell you, when Rob Vinnell starts visiting your market, something interesting is going on. And if he visits twice, it's really interesting. So I'm really delighted to be here and very happy to share with you all what I know.
And Graham, I really enjoyed the conference you organized. Thank you again for inviting me to that. Yishin.
Hi, good morning, everyone. My name is Yixin La. I run a equity long short fund out of Tokyo. But I call my strategy China Nexus. Means I have China direct exposure. I have China exposure companies, so I would long and short stocks in other markets, but that has a significant China exposure. And then I will have investments in business outside China, but based on my experience in China, if you can say that way. So I thank you again, Rob, for inviting me, and it's been great for me to be here. I really loved ambience here and loved the audience here and connection with everybody.
Yeah, and just while you still have the microphone, you grew up in China, if I remember correctly?
Yes, born and raised in Shanghai. A quick background on myself. Born and raised in Shanghai, so I probably one of the shortest investment experience for a lot of people here, because if I didn't know what an EPS is until my mid-20s. Start my investment career and with a private equity firm called City Capital in China, and then after business school moved to public market and been doing public investing since 2012.
Perfect, thank you so much. Fred.
Sure. My name is Fred Liu. I run a firm called Hayden Capital. We're global investors concentrated predominantly long only. And we've been investing in China for a while now. Generally, it has been a lower % of our portfolio, but we really ramped it up in 2022. My background is I'm actually Chinese American. My parents immigrated to the US in the late 80s. I was raised in the US, but I've spent a significant amount of time traveling back and forth. So I view myself as multicultural and literally just came back from China less than a week ago.
Yeah. Probably visiting relatives back in China or?
Yes, and eating good food.
Perfect. And Sophia?
Hi, my name is Sophia. First I have to issue a CYA for compliance that all of my views and opinions are of my own. So now that's out of the way.
We only want your opinion, so that's fine.
I'm an international and global investor, so I work at a long-only fund. We're very long-only. Our benchmark is very much like MSCI World ex-US or like a global benchmark. So, there's a portion of the benchmark that is still in China. And I grew up until I was 6 years old in China. And then I moved to Canada where I had most of my education until US college. And luckily, when I fell into investing right out of college, I fell into the time when actually the first wave of, the honeymoon period started with China, with Alibaba's IPO. So I was the only Chinese or Mandarin speaker on the team, and they just sent me there to do due diligence. And so I kind of saw through this period as a lot of global capital came into China and kind of saw the waves of it. And my best thing for China, and I love the country, is because it justifies, like, wow, Chinese investing justifies all the numbers of hours I spend binge watching Chinese dramas. So that's kind of like why I want to continue, to continue justify my hobbies.
Yeah. Yeah, what I love about all four of you is that you're all managing global funds, so you don't have an axe to grind. If everyone was running a China fund, they'd probably be saying, oh, you've got to invest in China, but you guys, you can invest in China if you want, you don't have to, so I think you're quite objective about that. So a lot of the group here won't have been to China, certainly since COVID and potentially not even before COVID. So I think there's a lot of question marks. People simply don't know what's happening there. So maybe one or two of you could just paint a picture of what you see in modern China, especially in the tier 1 cities when you go there today. Who'd like to take that one? Fred, you go first then.
I mean, I think the last couple of years has been pretty traumatic for a lot of Chinese families, especially for tier 1 households and those with a lot of investable assets. So real estate prices in a lot of cities are down 30%, 20%, et cetera. I think recently with policy changes, you've maybe seen some stabilization, a little bit more optimism in the last couple months, and you're starting to see signs of green shoots. But from a consumer sentiment standpoint or consumer confidence or investor confidence standpoint, it's still pretty pessimistic. But day-to-day life is going on normally. All the restaurants are full. There's lines out the door. People are still, living life.
Yeah, and maybe one of you would like to describe what modern China looks like. So what do you see when you go to a tier 1 city today? Should one expect a sort of, I guess, nominally you have the name communism in the name of the country. Is it a communist place, or what do you see? Yeah, Yixin, why don't you take that one?
There are definitely elements of that, but I mean, depends on where you go. So I have the luck of growing up in Shanghai and see this tremendous change of the city since the 80s all the way to today. If you visit it in 90s, it will be something like Cuba. We will have the communism huge square and all the buildings representing Soviet Union's age. And if you visit it in 2005 to 2010, you'll be like, this is the best city in the world. Why is Tokyo look so old? And I think 2023, so November 2022 is when the government lifted the lockdown. And spring 2023, I went back to see my family and walk down the street. That was probably the most depressing moment in my relationship with my home city. I took a 2-hour walk from the center of the city from, for anyone who knows Shanghai, West Nanjing Road, where a lot of the commercial spaces were, all the way down to the bar area in Xintiandi, and I counted less than 5 foreigners. And I was like, this is not Shanghai. We're known for a trading city. We're known for having a very diversified culture. During my adulthood, it's always been the world's best chef came to Shanghai. We have the best bars, everything. But that was probably the lowest point. I would say from that point, it has bounced back. My last few trips back, seeing more international people, seeing the city coming back to more constructions and continued innovation, especially on retail and tech fronts. You are seeing, even though it's a very depressing environment for entrepreneurs, their VC capital has dried up, PE capital has dried up, they still find ways to build new business and keep it growing.
Can I add something to that? Okay, so I think the question was like, what would you go if you see there, and could you tell if China's a communist country? I think it's really important for everyone here who hasn't been to China or who hasn't invested there before to understand the Chinese model of economic development. And the starkest reality is to look at the per capita income of the average Chinese person over the last 30 years and to see how that's gone up. I forget the exact number, but let's say it's 20x. And then to compare that to the MSCI China index, which has been virtually flat over the same period of time. So clearly there's a disconnect between what's been working for society, building a prosperous society, and what's been the return delivered to minority shareholders in aggregate in public companies, because, yeah, the latter's kind of sucked. And we were talking about, like, is this a communist country? I think, first of all, it's important to recognize and at least acknowledge that China is a communist country. This is the governing ideology of the place. And that's how they have operated and built like their structure. And number two, as far as we're concerned, the state still plays like a very important and fundamental role in capital allocation across the economy. So the state every 5 years sets its plans, 5-year plans. They target like different industries or regions for development, and they allocate capital either through credit, tax breaks, or giving out land. And that is why, like, you know, you have 100 plus EV manufacturers. Because every local government wants to, you know, develop their own local industry or take advantage of subsidies in one form or another. And I think the disconnect between like what has been very good for the Chinese people and very bad for investors and public companies is that supply comes online very quickly and very fast, but that supply is like the death knell for good returns on equity. So I think that's like a really important point that I want to emphasize. Thank you.
Yeah, and maybe just to add, I think labeling countries as communist, socialist, democratic, autocratic, it's very hard because those come with inherent biases about how a system actually works. And so, you know, as an investor, I try to strip away all those titles and see how integrated is this country into the world economy? Are they following laws or rules, and is there like private property protection? And then if I start to go down the checklist, I just try to think about it in terms of aspect of how I can understand it as an investor and facts to make opinions about, hey, what are the things that can generate returns over time? What are the things that are immune to more of that supply dynamics? And so that is a better way to kind of, I think about a country as opposed to using labels, because when you use a word like communism, you kind of put like China and Cuba in the same bucket. And those two countries are very different in the way that they actually work from a government and economic, legal perspective.
Yeah, I would just lastly add that from a business perspective, I think China is probably one of the most capitalistic and Darwinistic places to ever exist. Starting a business is very, very tough. There's a lot of people, there's a lot of competition, and so kind of if you can...
It's tough in the sense of the competition, not tough in terms of being allowed
to
sell.
Yeah, in terms of standing out above the competition. So, you know, Graham alluded to like the EV industry, a lot of restaurants, a lot of consumer brands. When you start to rise to the top and can make it in China, it kind of means that you're probably at a global level and of global quality that you can start moving abroad. And so we're starting to see that this year. We're starting to see a lot of bubble tea chains, whether that's Haiti, just launched in LA and New York. Luckin is going to come to the US. Heidi Lau has already been here for many years. So you're starting to see Chinese consumer brands start to appeal to a global consumer as well.
Yeah.
Sorry. Yeah. The last thing I would also say is that when you look at China, you probably have to look at it from a different lens than a Western perspective, especially reading the Western media in the last 2 years. It's been a little bit frustrating. Just because, for instance, a lot of people talk about why doesn't government just flood, consumer stimulus into China, similar to what the U.S. did, and it just doesn't necessarily work. Because the needs of, say, someone in Shanghai versus Changsha versus like a tier 5 city, like it's just very, very different. So decisions need to be pushed down to a local level, and local governments are in very different financial places at the moment. Yeah.
And then Graham.
Yeah, so sorry, just getting triggered on what Graham was saying. If you look at China overall versus 30, 40 years ago, we're a very capitalist country in the terms of 90% people are employed by private companies. When I grew up, most of my parents worked for state-owned companies. 90% of the population worked for state-owned companies or government. Today is no longer the case. If you look at GDP contribution, private sector is probably 50% versus 50-50 to the state. Then if you look at the asset base or bank financing, 90% go to the state-owned system. So the country has very different sectors, and depends on which sectors you're investing in, you can be super efficient. So all the I would say private dominant sectors like internet, consumer, is cutting throat competition. Only the fittest can survive. But if you're talking about state-owned sectors, via different rule of the game, I'm not saying they're not competitive, but they're different kind of competitive. So it is still a very mixed state. And I wouldn't call it communism, maybe a state capitalism. Yeah.
Graham,
I want to make 2 points. Well, to illustrate one example again about like a common fallacy that I've made, and I think a lot of other people have too, is to focus on demand and the opportunity for growth in China. And one example that I've heard recently is coffee. So, you know, you have all these studies which say like the per capita coffee consumption in China is like 1/20th or whatever it is in the UK or in America. Massive opportunity to grow. But as an investor in China, like you really have to pay attention to supply more than anything else. And there's this wonderful company you guys might have heard of called Luckin Coffee, which when it IPO'd, like they cooked the books, all that kind of thing, went really bad. Crazily enough, the guy who founded Luckin was a fraud, was kicked out of Luckin, left, and then started another coffee company called Coty. And lo and behold, through franchising, he's been basically cut out of any kind of like capital markets now, but through franchising, he's grown his store count to almost rival Luckin's again. And in the space of about like 18 to 24 months. It's really crazy. And then other companies see like coffee and kind of see stars in their eyes. And now like Yum China is adding a cafe to like every outlet. So yeah, again, like demand seems very seductive, but really you got to focus on supply.
Yeah, and the crazy thing there is as well, even though Luckin, I think, was cooking the books, like you say, it's still gone on to become an incredibly successful company. So that's some of the contradictions you have in China.
And if I could just take another step back, and sorry for doing that, I want to give everyone here like a higher level overview of where I think China is today in terms that you might be able to relate to. So ever since 2008, China grew its economy primarily through fixed asset investment. Either in infrastructure or residential real estate. The residential real estate market got very overheated, and in 2021, the government finally said, you know, we're going to deflate this bubble and try to transition the economy away to a more healthier footing. So for the last 3 years, China has been undergoing this massive deleveraging. It's been very painful. And the analogy that I think might help you to understand this is to think about the US circa 2010, 2011. So the subprime crisis popped, I think, in 2006, but it took a long time for the US economy to repair its balance sheet. And during that time, like aggregate demand was very weak. You know, the economy was constantly like flirting in and out of recession. Monetary policy was cut to zero and was having no influence kind of thing. Animal spirits were in the dumps. And that's basically where China is today, like in very, very loose terms. So in addition to like all the things we're talking about, I want you to have that economic backdrop in mind. Because there's definitely some important and very difficult headwinds that China is facing today. Yeah.
Without wanting to ask too much of a leading question, but I will do anyway. You know, I think one of the associations with a state-led economy is very slow, inefficient companies. Clearly, that's not the case in China. Maybe you can just describe the dynamism of Chinese companies you see. Sophia, why don't you grab that one?
Sure. I mean, I think I want to echo the sentiments of all the panelists up here. It is like the country with the fastest amount of supply growth for any particular sector that I've ever seen. So I'll have an example in autos, actually, because I was having a lot of conversation with auto manufacturers, chip makers, and in particular, how fast the electric vehicle development in China has been. I mean, before, right, Europe, America, on the forefront of electrification. But now if you look at, for every car that is bought, I think in China, something's like 40% of new cars are like already electric. And we're talking this year, more than that, yeah, like we're talking this year, you know, Europe and US actually might go back to more hybrid and even combustion vehicles. And when you look at the development cycles of electric vehicles, a lot of the auto chip companies would come out and say like, I have never worked with companies where the product cycles have actually decreased as complexity has evolved. So if they're working with like the European counterpart, maybe the product cycle would be like 4 years or even longer. But when they're working with a Chinese electric first company, it's so short, it's like 18 months, 24 months. So the accelerated development in China for some of these industries is at an incredible pace that if, you know, as they think about exporting electric vehicles to other places, they're gonna be extremely cost competitive. And what that means in terms of pricing from a supply and demand perspective. So in China, I was reading this statistic where, like for a sedan, electric sedan in China is probably like 30% cheaper if you were to buy as a consumer, whereas in the developed markets, it's actually at a 20%, 30% premium, and that goes actually higher the larger cars you get to, like SUVs. So as you think about these type of dynamics and how fast China is actually moving in competition, supply growth, and innovation, it's actually pretty spectacular.
Yeah. I have so many questions. Fred, go on, and then I'm going to ask another one.
I was just going to add, I think something that's really unique to China is just the integrated supply chain. You know, what Sophia was talking about. Because, you know, a lot of our partners, you know, some of them based in China actually run factories. And so I've had conversations with them over the last couple of years about, you know, they're getting pressure from their own clients, many of them, whether Japanese brands, Western brands, et cetera, to move offshore, out of China. And so they talk about opening factories in Indonesia, in Vietnam, et cetera. But the one gripe that they constantly have is that, yes, labor costs are lower. Maybe it's, you know, 30% lower. But the inefficient supply chain actually really kills them. So for instance, if you're manufacturing in Vietnam, it might take a day or longer or, you know, a week for your parts to arrive, right? And sometimes you have to hold excess inventory inside of your factory to, you know, manage these uncertain timing, et cetera. In China, your supplier factory is probably 20 minutes away. You need extra parts, it's coming, you know, very, very quickly. In addition to a lot of these other countries just don't have the skill set or knowledge base in order to, you know, have great quality control. And so you have to do extra checks, so it's extra layers of costs on your business. So oftentimes when you manufacture abroad, it's probably 10% or 15% more expensive than manufacturing in China, even though labor costs in China, you know, workers are probably getting paid 10,000 or more RMB per month with extra holidays, et cetera.
Yeah, that kind of anticipates a little bit my next question, because one of the things, I think there was this perception in the West, certainly 10 years ago, maybe even to a lesser extent today, but it still exists, that Chinese people have always been super hardworking, but the economy would always be focused on sort of commodity, sort of manually intensive sort of jobs. And you know, and I think up until about 5 or 6 years ago, there wasn't any sort of single important Chinese international company of note. And then the last 5 years, across all kinds of sectors, whether it's, you know, kind of TikTok, BYD, or, you know, many others, it feels like Chinese companies have suddenly emerged as these formidable international kind of competitors. So maybe I can ask you, Yixin, first. What changed over the last 5 years?
I don't think it's a matter of 5 years. Maybe it shows up in the 5 years, but there has been such huge change in the entire education system, in the people who start business, all the business you mentioned. These are started by entrepreneurs who might be born and raised in China, but they went through a US education system. They worked for some of the top tech firms and then returned to China. And they went back into a system which produces 2 million engineers a year, which they can hire and who works what we call 996, 9 to 9, 9 a.m. to 9 p.m., 6 days a week. So that's what you need in tech, where the speed of product development need to go really, really fast. I'll provide a small example here. I did some work on EV, and one of the experts I interviewed works with a Shanghai-based auto manufacturer, but also has a JV with a German auto manufacturer, as you would have known. And I was asking, what's the development pipeline looks differently for the China EV brand versus the Europe-based brand. He was like, yeah, we in our German partner, they already they foresee the transition, and it's not just about building battery. You need a software-defined cars. You need to build an OS all over again. So they hired 4,000 engineers across Europe, and here we have maybe 2,000 people. But 6 years onward, we are on our second iterations of cars running on the road. And our German counterparts has only come out with the first OS. And interestingly, they found it couldn't do over-the-air update on their OS software, and now they have to overhaul it, redo it again for another 6 years. And I asked him, how does that happen? And he said, you know, in software development, there are so many interdependencies. You can't have everyone working in different countries, and unfortunately, you can't have one of your team take 8 weeks vacation in the summer and come back and pick it up again. If another team raised a question this morning, my team will have it solved by end of the day, whereas my German counterpart will say, well, let's wait till summer vacation is over. So that unfortunately has explained a lot of the difference in terms of what you mentioned about product development speed of innovation. But I will say there's a limit to that. The younger generation of Chinese people are not going to put up with working 12 hours a day, 6 days a week forever. We probably won't take job from everybody in the world, I think. Yeah.
Graham, why didn't you chime in?
Yeah, so I want to say, Rob, you said how come all these companies just appeared suddenly. I think these have been overnight successes, decades in the making, is the honest answer. Like if you look at Wang Chuanfu from BYD, he set his sights on building an electric car company, from the early 2000s. Started off as like a battery maker, but he knew from day one, like this was going to be the ultimate end market. And, this guy is a visionary, but also kind of a little bit psychotic with the way that he was so committed to reinvesting. And lo and behold, he's there. And then maybe why are you seeing these today in your markets? It's because China is so tough right now. It's so much easier to go to like Switzerland or Europe and compete over here, right? So that's what a lot of businesses are doing. I mean, I think you've written about Temu, for example. Yeah.
Anyone else want to chime in on that one? Yeah. So it's kind of interesting because in your opening comments, you all sort of described how kind of tough the situation is in China at the moment, which no doubt it is. But then when we started sort of riffing about the companies, I could see your enthusiasm about the competitiveness. So, the tough situation the market is in today, is it like sort of the US in 2008, 2009, great financial crisis, everyone's super pessimistic, but with the benefit of hindsight, it was cyclical and, the US went on to bigger and better things a few years later? Or is it some kind of structural problem which is going to lead to sort of the kind of permanent sort of challenges for the economy?
So I made the analogy that China right now is kind of like where the US was circa 2010, 2011, repairing balance sheets, aggregate demand is weak, animal spirits are in the dump. I think that part is cyclical. What is perhaps structural is the change in the international situation, because China and the US are diverging, and I think that has all sorts of implications for the risk of this asset class and the prospects for Chinese companies abroad.
Yeah. Fred?
Yeah, I would just comment that I think investing in China, for the last 2 years versus going forward is probably going to be very different in terms of investment opportunity. Just I don't know what the economy is going to do. I think China on a high level is probably just maturing as a country. And so GDP growth absolutely has to slow. But at the same time, 2 years ago, most of our investments were made in 2022. That was a different period. You could find a lot of deep value investments back then.
You couldn't, or you could?
You could.
You could, yeah.
Yeah, because there was a lot of forced selling in the market, whether for various reasons. A lot of institutions were selling, and a lot of funds themselves were selling. And so you could buy things for literally below net cash value. Even today, yeah, you can still see it. There was definitely more in 22, but even today. I think in the last couple of years, what's also changed is, Chinese companies have started to return capital. Whether forced, whether for ulterior motives, or whether truly to benefit shareholders, that's debatable. But they are returning capital. So Alibaba has bought back, call it 10, 11% of their market cap. You have companies that are paying back the entire market cap in terms of special dividends. Lufax is one of them, I think 96%. Huya, that's a struggling business, but it paid back about 60%. So you are seeing capital returns, and if you did dedicate the time, maybe you could have spotted some of these opportunities. But the problem is that, most of the capital in today's world is probably from the West, and there is less interest coming from the West, which means there are fewer people looking at the market. Also, in terms of just research analysts and sell-side analyst resources, I saw a stat that globally there were 4,500 research analysts. That has gone down to 3,000. And a lot of that has actually come from Asia as well, which means lower coverage, which means fewer people looking at these ideas on an individual level. And so cost of capital has gone up. Perceived risk, whether real or not, that's gone up. Less liquidity, fewer people looking at these markets. You probably have to specialize and do real deep work and have the right connections and network to do the work in China, which requires time. That's an increase in cost of capital. And so you look at the Chinese markets trading called like 12 times PE. That's a high single-digit yield on your asset, not including any growth. Earnings growth is looking to be about like 15% projected for this year. That's probably reasonable. But you can find companies that are trading at like 8 times to 12 times, growing 40%, 50%, while other things are trading at the same level and like not growing at all. So it's kind of a stock picker's market going forward, in my opinion.
Yeah, Sophia?
And I would just add for context, and I think I joined as an analyst at a time when a lot of actually global capital started coming into China, which is around like the mid-2010s era with the IPO of Alibaba. So like we've kind of we saw a long cycle, like a decade cycle of China exuberance, and like something's happened. And I think for me, like what I see that there are definitely issues, whether structural or cyclical, and like what I see is, look, about 2/3 of wealth is still tied into real estate, and that is a problem that still has to be solved for, corrected for, as the government tries to encourage policies of investment elsewhere. Because when real estate prices don't increase like they've increased over the last decade, people just feel poor. And when people feel poor, they don't know what that discount rate for their own futures are. And so this is feeding into the current consumption problem right now. Is even if the government gave me $100 to spend. This was not America COVID, where like, government gave me $100, let's leverage that and then spend it. These are people who are in a country that is still developing their social welfare nets, where they have to think about taking care of the elderly as they get older, and thinking about all of that to be like, wow, if I got $100 today, I'd be like, I'm saving it, because I don't know if my wealth is going to improve. So I think there's actually some real issues that China just has to work through as a maturing country, that every country who's gone through this journey has kind of yet to work through. But on the other side, there's also a lot of opportunities, whether in terms of valuations or companies who also see this trend and capitalize on that. And so there's companies we see today, whether benefiting from like people shifting wallet share into travel from goods, or people kind of trading down and finding really good value in things, or people understanding that China needs to pivot into more deeper tech innovations. Those are all actually opportunities. And when you find companies that understand policy, because you have to, it's kind of like if oil companies don't kind of foresee commodity risk and how the pricing move and can't react to that, good Chinese companies, good Chinese operators also needs to see the larger trends driving the economy, and also how they benefit people and the living standards of everyone, and take advantage of all those secular trends.
Yeah. So do you want to briefly chime in on that? Then I have a couple more questions before I pass it over to the audience.
Yeah, I just want to echo what Fred just said. I'm through my investment career, which has been 15, 16 years, this is actually the moment I love China. Because back in 21, I just look at all the stocks, and people were, sell sides are coming out with increasingly creative valuation metrics like, oh, PE is not good, PEG is not good, maybe let's do PS. Well, maybe let's do PS 20 years down the road. I'm like, what can I buy? So I couldn't find anything I want to buy. It was really, really hard. But today when I look at it, and like Rob said, I look at Japanese stocks, I look at US stocks and Chinese stocks, that I just have to come back. There's such high quality business trading at such reasonable multiple. And believe it or not, with me managing such a tiny amount of money, I can get a direct access to Alibaba investor relationship and get them to answer my question on the footnote of the annual report. What's better than that for a stock picker?
It's always a good sign when investor relations return your calls quickly.
Exactly.
Okay, tariffs. A lot of Western companies are clamoring for protection from Chinese ones. Short term and long term, are tariffs bullish for the Western companies hoping to be protected, or for the Chinese companies which are potentially going to be impacted by them? Fred, you're smiling.
I mean, just very briefly, I would say that tariffs just buy you time, right? Eventually, the superior products will win out in one way or another, whether that's through lowering your cost enough to offset the tariffs, or just simply creating better products that everyone wants and is willing to pay a higher price for. And so I would say in the long run, you would want to back the companies, as you were saying yesterday, that are being subject to the tariffs because everyone else is scared. In the short term, it's absolutely going to create a lot of volatility and a lot of noise, and it's going to create a lot of disruption inside of these companies for how to reorganize. But I would say that, especially for a lot of consumer goods and what we were just talking about, integrated supply chains, cheaper products, et cetera, most likely a lot of these companies will be able to find a way to offset the tariffs in one way or another.
I think this speaks to a larger problem, Rob, which is that there's overcapacity in China. There's more being made than is being consumed domestically, and so Chinese companies are now increasingly dependent on export markets to absorb that extra capacity. And that is creating a lot of friction internationally. But the core problem here is that consumption is too low in China relative to its potential. So, rough numbers again, I think consumption as a percentage of GDP in China is about 40%, and that might compare to like 70 or even 70% in India, or maybe even 80% in America. So really, like the structural change, which is going to transform China, will be, I guess, a shifting in mindset, policy, and everything, which raises that consumption as a part of GDP.
Yeah, I think this is an age-old debate, which we're probably not going to resolve today, but I mentioned yesterday I read this book about the Bretton Woods conference, and after the Second World War, of course, the US was the position of having this huge export surplus as all the European economies are on the floor, and the European economies were saying, hey, you need to get rid of this surplus, we need to import more. And the US, at the time, the sort of the surplus manufacturers, no, it's your job, you need to increase your exports. So it depends oftentimes. People, I think, are very self-interested when it comes to that. Yeah, Yixin, I think you wanted to chime in.
Yeah. So if you look at the U.S. deficit versus China, I think the biggest category is consumer electronics. That would be like 30-40% of the total deficit. And if you just think about how realistic it is to either reshore those manufacturing or find a third country that can do it, it's just not a 1 year, 2 year, or even 5 year exercise. Apple started looking to move their entire supply chain to India about 6 years ago. Guess how much they produced out of India last year? 15%. Their goal is to get to 30% in the next 2 to 3 years. So, but you can say it is Chinese building too much for other countries, but it is also a decision actively by international companies to put their manufacturing base in China. The reason Apple can only manufacture in China at the scale is it's a very short life cycle product. Every year you need to make it, and the short selling season for Apple phones is very short. It's only 3-4 months between October when they announced the model till Christmas season. And that's where so think about the supply chain you have to manage. And how many units for Apple is about 200 million every year. You have to manufacture that many for a 3 months selling period. So what you need is millions and millions of skilled workers who are willing to work 10, 12 hours a day, non-stop, for 3 to 6 months. And where do you find those labor force? Definitely not in the United States.
Well, I don't know. TSMC is pushing people pretty hard in Arizona.
hasn't really worked so far. So I think it can happen maybe when robots and AI can do all those jobs someday, but it's going to be a very long exercise. So whenever I hear these news about tariff, my first question is, what is Apple trying to do, and how the conversation between Tim Cook and whatever the Treasury or the Department of Commerce is happening?
Yeah, that's a great point. Did you want to chime in there, Sophia? And then
Yeah,
I have one last question before passing it over.
Yeah, so just on that, I think there's the tariff side of things, and there's two ways I think about it. One is when you put tariffs on something, who's paying the ultimate price for it? it's the consumers. When everyone sees inflation go up again, I think it's going to be something that is going to be top of mind for politicians if you start to tariff, because China is just so efficient, right? Like, I didn't do well in economics, so this shouldn't come from me. Like, economics 101, you know, the country with the most competitive place to produce will end up being the producer. I think that's on one end. On the second end is what happens when you tariff a country that is already so bent on survival is you're forcing them into a more survival mode. And in Art of War, you say what you don't want to do is you don't want to force them to a place and then take out the ladder, because those people are going to fight to the very death. And so over the short term, it creates a massive volatility. It creates inflation in prices, but on the other end, all the Chinese companies that are going to be tariffed are going to be hell-bent on getting their prices to the lowest possible, even including the tariffs. So over the long run, we are actually making China even more competitive if we tariff them in the way that a lot of economies are looking to do, as opposed to trying to think, how can we make our own companies more productive? How can we make our own people more productive so they can actually compete fairly and globally?
Just really quickly, I would say the best example of this, especially from the last administration, the Trump administration, was probably Huawei and the resurgence of Huawei. Because, you know, there were a lot of restrictions placed on Huawei under the previous Trump administration and whatnot. But if you look at the company today, it is thriving. They might have one of the most expensive cell phones out there at $3,000. It's a tripod cell phone. They have, you know, world-leading cars, EVs, for instance. And my point is, like, tariffs or not, if you create great products, people will want them, and you might even be able to command a pricing premium for it. Yeah. And so just focus on bettering your product, and I think China is starting to get to a point where, you know, on a global level, their products are very, very good.
Yeah. I think a lot of people would be nodding their heads as you describe the strength of the Chinese companies, but I think a concern would be sort of ownership rights. So how concerned are you when you invest in China of getting your money back?
Well, I think that was a very big controversy and point of debate, you know, probably 7-8 years ago, right, with the VIE structure and whatnot. And I think the last 2 years, like I mentioned before, you're starting to see capital returns, and a lot of people didn't believe that you actually could return capital through the VIE structure, which, by the way, capital has been returning through that structure for like 20 years. But, you know, investors kind of omitted that fact. But yeah, you're seeing a lot more capital returns, and yes, it is a different structure, but, you know, at the end of the day, it's just whether is management on your team or not, and do they care about shareholders, and whether I'm a U.S. company listed in the U.S. or I'm a Chinese company through a VIE structure. If I'm looking to, commit fraud or, screw over shareholders somehow, I'm going to find a way, regardless of the structure, right? So, yeah.
So I mentioned before that I'm from Hong Kong, born and raised there. My family's there, so I'm kind of literally voting with my feet, skin in the game, all of that. Honestly, I'm not so worried about the scenario that you're describing, like expropriation or whatever. I'm more worried about like bad management setting my money on fire. And that's just through like bad capital allocation, which I've seen again and again and again and again. Either chasing growth when it's no longer like profitable, going into like non-core businesses, or my favorite, buying real estate. So yeah, I'm much more worried about that.
Some of you may be staying in the Kempinski Hotel, which is a very beautiful hotel down here in the valley. That was financed by a Chinese entrepreneur. Okay, I have a million more questions I'd like to ask, but I'm going to pass us over to the audience. So Tommy, if you want to maybe grab one of the mics here and raise your hands. Is that Alex? Or I can't see. There's one at the back there. Yeah, take this one.
Question from the internet is just, could you comment on demographics? So, real headwind, not a lot of desire for immigration to China, so hard how that's solved over the next couple decades.
Yeah, it's one of my investment themes. I mean, it happened before. If you just look at Japan, they reached peak population about 20 years ago. Economy wasn't great, especially we also coincided with them in terms of the real estate bubble went bust about the same time. But is it still investable? If you look at Japan 30 years ago, it was pretty investable. There are a lot of Japanese companies that create value in sectors like Uniqlo's of the world. You look at a large conglomerate accumulated assets globally. There was innovation in tech space. I mean, we are stock pickers. We don't need to own the whole market.
Robots.
I like one-word answers. Next question. Just there. Oh, sorry. Yeah.
I think a common theme that I heard was like supply coming on rapidly. So two-part question related to that. What is this, like, what do you think is the source of that difference in supply? And then secondly, I think someone mentioned capital drying up in the country. How, if at all, do you see that changing that dynamic?
That's an interesting question. Fred?
Well, I would say just at a high level, how China typically operates when they enter a new industry is by throwing government support behind the industry to get to because there's a certain level of R&D and fixed costs that you have to cover in order to get to a place where you're competitive on a global level. So if you look at EVs at the Detroit Auto Show, 15 years ago, 14 years ago, people were making fun of those cars because the gaps between the door and the actual chassis was like 2 inches wide, right? But you iterate enough and you kind of throw money enough at the problem and iterate and then first serve your domestic market and then iterate there and then go globally. That's typically how China has operated in the past. So a lot of that excess supply is kind of a remnant from that period of time from ramping up that industry as well.
Yeah, whereby I don't think it does just justification to the strength of the entrepreneurship in China to suggest it's just because of capital, right?
So just to add to that, I think there's a recent book by Professor Xu Chenggang from Stanford that's called, I think, Systematic Gene. And I think there's a really helpful analogy to say the Chinese system, you think it's a dictatorship, but it actually is a decentralized dictatorship, meaning the big policy are made in the center. However, among all the provinces, there's a competitive relationship. So coming back to this overcapacity issue, every government province is operating like this megacorp, and they are trying to maximize their tax revenue for the long term, maximize their employment locally. So whenever they see a growth opportunity like EV, they're just like, I want the best EV company to be in my province. How do I compete with the next province to me? So you give 30% capex subsidy, I'll give 50%, and then I'll give 100%. So that's what happens. That's been a big problem. I think they need to solve that issue. So from some unofficial stats, I think there are 60 million auto capacity annually in China, and our annual sales is about 20 million. So partially it's because no provincial governments want their baby to go out of market, but it has to. Otherwise, there's no clearance of this market, and there will never be profitable companies.
Yeah.
And I don't think, great question, Gabe. And I don't think capital is scarce in China. I think there's like an overabundance of it, actually. The problem is like it's not being allocated optimally. So you've probably heard of Evergrande, the property company. You've probably not heard of Evergrande Hangzhe, the Evergrande car company, which I think Evergrande launched as an attempt to get subsidies to keep the real estate business afloat. So that's like an example of where it's not going so well. And then I mentioned before the example of like Coty Coffee, which exploded from 0 stores to almost I think like 16,000 or so in 2 years. And that to me really speaks of like unfortunately like the desperation of some people looking to get a better return on their assets, given how weak their businesses are, maybe how vulnerable their jobs are, or the lack of other alternatives for their savings.
Great.
And sorry, I'll just add on one point to that supply thing was another anecdote would be the semiconductor industry and the decentralization that was mentioned. It's very prevalent, right? Like there's like a mandate. We got to invest in semis. Every local province is like, oh my God, I need to invest in semis. So they all, put a lot of capital behind building up these fabs. But the thing about China you have to remember is as much as supply comes on really quickly, the environment also can rationalize just as quickly. I think back to the internet days of couponing and consumer subsidization supply in the O2O industry, what it was called in the 2010s.
So local services,
yeah. The local services, the online, offline, the local services. There was like Meituan, Ele.me, and a handful, Koubei. Like all of these came up with these. I basically will just pay to get consumer retention, LTV. And in the private side, I was like doing the data. I was like, You know, it started from like maybe like 100 companies or something, and like quickly rationalized like the second year, like cut in half, and then eventually it became like a 3-player market, and now it's dominated like really by Meituan. So as fast as supply can also come on in China, it can also rationalize itself very quickly through competition because they just can't survive.
Great. Over there.
So my question concerns more the, as you mentioned, corporate governance and capital allocation as a way of destroying value rather than created in Chinese companies. And I would say, what's your opinion, and do you have any experience with doing activism on Chinese companies? And how is it received? What's the best way to do it? And also non-contested activism, so not Bill Ackman style, rather like more behind the scene and things like that. That would be like.
Okay, well, guilty as charged. I started my investing more on the quantitative side, and Hong Kong is just like littered with companies trading like well below book value, high dividend yields, all that kind of stuff. And me with my little pocketbook, I thought I could change the world by writing lots of letters and getting in people's faces. It didn't work, unfortunately. You're very much pushing against closed doors. And I think, frankly, a lot of the people in control of the companies I was looking at had incentives other than raising the share price or creating value for me, a minority shareholder. So in the end, I decided, hey, it wasn't worth it. Yeah.
When back in my private equity days, we actually had a SOE privatization part of the business. So maybe not public market activism, but you actually need to go into SOE and fire people, and try to change their structure. My summary is it doesn't work. I think the activism you can do is probably more like the friendly one that Rob does with most of these entrepreneurs that he invested in. If you build a trust with them, you can present them what you think is the right thing for business to do, and what is time that they should do capital allocation or shareholder return, how to structure those. And I think a lot of entrepreneur-led business are very open to those suggestions.
Yeah.
Can I just add one more thought? So we're probably all familiar with like the 2021 tech crackdown in China. When the government just kind of came out of nowhere and said like you can't do a lot of things. That might have actually been like one of the best things ever to happen for capital allocation in China tech, because they went from focusing on maximizing revenues and their reach to really focusing on maximizing earnings again and returning capital. So I think that's a great example actually of where the mindset changed. Yeah.
Yeah, I think it's like Will said earlier, if there's a sort of a fundamental openness towards it, there's but if people don't get it or don't understand it, then I don't think hostile activism will get you very far. Yeah. I think we've got time for one last question. Yeah.
My question, a lot of media outlets are painting a relatively negative view on China and China economy. I wanted to ask, do you have favorite media outlets or reading recommendations to get a more differentiated view on the Chinese economy?
Great question. Yeah.
I think first of all, I think there's a lot of media distortion everywhere, and sometimes the media capture bits and pieces because they want to be clickbait for everything. But I think to understand any country, if you're going to be invested in a country, go to the country. Do your own visits, talk to people who live there, and I think that's the purest sense of truth that you can get, because you can remove all the biases, you do the diligence on the ground, and so you don't like, I actually close like half my news sources because it's all very much noise, and just go. Like right now when I go to China, I see the same thing that Fred sees. Definitely there are struggles, but at the same time, I'm trying to get a sense of why things are happening, how people are responding, and I think that would be my best way of handling it.
I would also just say read very widely, so don't trust one single source. I probably get like 10 different newspapers delivered to my inbox every single day. So Chinese media definitely is biased. Weibo is going to give you a different outlook than Twitter. So just read everything and then put together your own perspective on things. And then one, I'd say like Substack that I really love, and I'm not involved anyway, so this is just kind of a plug for them. But Baiguan by Robert.
Can you say that more slowly?
Yeah, it's spelled Baiguan. It's a Substack. Robert does a very, very good job of outlining what's actually happening in China from a Chinese perspective.
The cheeky answer is if you see an economist who speaks and then gets banned 2 weeks later, he's probably saying something interesting. So go check that out. We can talk afterwards if you want the name. And then if you want something like more structural, like kind of really, a framework for thinking about this, go read Li Lu's stuff. A long time ago, I translated some of his work into English, but recently he put out another piece last month, I think, where he gave some very specific analysis on how he sees China and what he thinks the government should do. So I'd highly recommend that. His name is Lilu. Himalaya Capital.
Yeah, and I would also give a plug. Fred wrote a letter a few years ago in the context of New Oriental explaining what he thinks Westerners get wrong when they invest in China. So I would definitely give that a big plug as well.
Yeah, I think that was from the summer of 2021. And so it's available on our website if anyone wants to see it.
No, I have fond memories of that. Okay, well, we'll wrap up the panel there, I think. So a round of applause for the panelists and then a few comments afterwards. Yeah, so it's amazing. Feel free to stay seated. We've reached the end of the weekend once again. It's difficult to believe. There's so much build-up and expectation, and then once we get into the moment, it goes by so quickly. But I'm happy to report this was the end now of the 9th meeting, which means next year we have the 10th anniversary, so I can't wait for that one. The date isn't fixed yet, but I hope to agree with Marcel, the manager here of the hotel, soon, and I'll be able to let you know. And I can't wait to see it. If there's anyone that's been for all 10, family members excluded, there'll be perhaps a special recognition next year. I'm curious if that will be the case. But we love to see returning faces, so I hope many of you can make it back next year. Thank you for coming, especially those of you who undertook very long journeys to get here. And all the best for 2025.